Okay, so I'm going to present the final foundation of our investment project as detailed on the second page of the Excel file. So this sheet gives us a clear picture of how our project is structured, financed, and how it generates value over time. So first, let's start with the initial investment. We are investing in four key assets categories: the establishment, machinery, furniture, and also electronic equipment. So the total fixed investment amounts to 210 million Colombian pesos, with each asset being depreciated linearly over its useful lifetime. For example, 25 years for the establishment and 5 to 10 years for other equipment. So this gives us an annual depreciation of approximately 12.96 million Colombian pesos. And these assets form the physical and also operational backbone of our business. They ensure production efficiency, service quality, and also, of course, long-term stability. Now, about the financing, we are leveraging our capital efficiently by financing up to 6% of the investment through a loan equivalent to 126 million Colombian pesos with an interest rate of 12% annually over 6 years. So why is this important? First of all, because it allows us to keep equity contribution low while still scaling operations rapidly. Yes, it generates annual financial costs, but they are fully integrated into our cash flow model and still allow for profitability from the first year onward. Now, let's get into the engine of our model, the operation cash flows. Over a 5 year period, sales grow significantly. So we expect that they grow from 555 million Colombian pesos in the first year to 735 million Colombian pesos in year five, showing the scalability and demand for our solution. Each year, we subtract the operational cost, the financing cost, and the depreciation. Then we apply a 37.5% tax rate to get the net income, but we don't stop there. We add back depreciation as it's a non-cash expense, and we subtract the annual capital repayment on the loan, of course. So the result, it's a strong and growing operational cash flows starting from around minus 319 million Colombian pesos in year one due to the big investment phase and turning into solid positive flows in the following years. By year five, the project is self-sustaining and should be cash positive. Now, at year zero, we clearly separate our fixed investment and an additional line called KW investment, which amount to 207 million Colombian pesos. And this refers to working capital or additional infrastructure costs, and it's fully integrated into our year zero cash outflows. So to sum up, this sheet shows a well-structured investment with a clear asset base, balanced financing mix, and a growing cash flow generation. So we think this project is not only financially viable, it is also strategically smart. It builds long-term value, manage debt in a wisely manner, and it brings early returns for the business. Thank you for your attention. Okay.